Good afternoon, ladies and gentlemen. Welcome to our webinar. My name is Monique Pisters and I'm the head of International Tax. I will be your host for today's webinar on Pillar 2. But before I start with sharing our agenda, please let me introduce our speakers of today, Jacob Moog, Head of Tax, and Onno Box, partner in our International Tax Services team. Thank you all for attending this webinar. Our agenda for today will look as follows. First, we will start with a bit of background on Pillar 2. I will ask Jacob and Onno some of the most pressing questions on Pillar 2. And I will also ask them some observations on the status of Pillar 2 at OECD and EU level. Subsequently, we will guide you from the technical theory to the practice, and we will present you with our 7-step approach, an approach we specifically designed to help you as clients to prepare for Pillar 2. Subsequently, we will end with a summary and next steps and some key takeaways. As with any webinar, we will of course have a Q&A. So if you have any questions during the webinar, feel free to ask them in the chat. And at the end of the webinar, I will ask those questions to our panelists. Rest assured that if your question isn't addressed, we will do that per email. And the presentation and the answers to your questions will be sent per email. And last but not least, please note that this webinar is recorded. Now let's start. Jacob, would you mind please sharing us some background on Pillar 2, where we stand and what the next steps are?
Yeah, of course. Well, getting it back a little bit back in history, you remember maybe that we had a race to the bottom for corporate income tax. So a few years ago, people were just protesting against that low rates. And that made something, of awareness. Hey, this is a good situation that countries are doing a race to the bottom for corporate income tax. So in that regard, OECD thought, hey, we have to do something else because this is not going in the right way. And they came with the idea at the moment that was something like, well, does it work? But they wanted to introduce a minimum tax rate of 15% anywhere in the world. And everybody was a little bit, will everybody comply with that? But in the end, you see that they did a big job, and 130 countries agreed in the end to do this. So, yeah, we get now the minimum tax. That is what we know. Certainly in Europe, maybe also another 130 countries. So there's really a big change in the world now.
Yeah, interesting. So you're talking about a minimum tax of 15%. Question to you, Onno, how are they going to achieve that?
Well, there are, let's say, 3 basic rules where you must take a look at. The first one is the qualifying minimum domestic taxation. The second one is the income inclusion rules, and the last one is the under-tax payment rules. The first one, the qualifying domestic taxation, is done at the level of the jurisdiction itself. So let's assume we have the Netherlands. Then we take a look at all the Dutch entities, and we calculate if there is an ETR, an effective tax rate of at least 15%. Is it less than 15%, then at the local level of the Netherlands, in this case, will be an additional taxation occur. The second one, the income inclusion rules, let's say mainly is when the ultimate parent is located in a Pillar 2 country, and it has subsidiaries which are not sufficiently taxed and does not implement Pillar 2 at the level. Then there is the possibility at the ultimate parent company to make additional taxation for the low tax subsidiaries. The last one, the under-tax payment rules, is whether when the ultimate parent entity is not located in a Pillar 2 country, and then it gives the right for the subsidiaries to have an additional taxation because the ultimate parent company is not making that taxation. And there is a division between the subsidiaries, which is based on the relation of the amount of the tangible assets and the amount of the wage cost, so they can make the division between the several subsidiaries.
Okay, interesting. So 3 calculation methods. And do I understand you correctly that a calculation needs to be made per company?
Yeah, and that's the complexity also of the Pillar 2, because if you're having a group structure with a lot of countries, for every country you must make a separate calculation whether or not you have an effective tax rate of 15%. And further, it's nice to mention that even if you have a group structure, which on group level is a higher than 15% taxation, but at the lower jurisdiction is lower than 15, you still have the possibility of a additional tax for the low tax subsidiaries.
Okay, so really per jurisdiction. That's interesting. Jacob, I just heard you say also how we know that 130 countries agreed on OECD level, and in December 2022, of course, the EU reached agreement that these Pillar 2 rules should be implemented as per January 1st, 2024. But it's now June 2023, so that is rather quick, right?
Yeah, it's incredible quick. So it's a very short time to be compliant. So from a EU perspective, what you see is, in principle, that the QDMTT and the IIR will be enforced January 2004, but UTPR will be 2025. So that's the difference here. When you look to the Netherlands, that's quite simple. It will all be enforced with the minimum tax. That's the plan now, to be into force in January 2024. So that's a short period. And remember then that in 2026, we have to also to do the filing. And for the Netherlands, it will be a filing date for, because there are two returns that we have to also to mention. So there will be an information return, which has to be filed on latest the 30th of June 2026, and 2 months later, on August 31, 2026, then you have to submit the Pillar 2 tax return. So there's a lot to do, and 2026 is, well, close.
Yeah, definitely. So with the approaching implementation of Pillar 2 in the EU, and also specifically, of course, in the Netherlands, with the law proposal which has been accepted, I understand that multinational enterprises should really take action sooner rather than later. Based on your experience as an international tax advisor, what would you recommend that these multinational entities should do first, and why?
Yeah, well, first of all, I think there has to be created awareness in the company about Pillar 2. What we see is that a lot of companies are not really aware of what's going on. So that's the first step. Of course, we have to also to see what's the impact for the company. So there has to be some analysis. So what's going to happen? Further, we think we could have two steps, more or less, a top-down step and a, well, more local step. When you look to the top-down step, we think that's good to do it on a high level. So what companies are in scope? Will there be exemptions, or will there be carve-outs that you're not, well, maybe you can not be into, that you will not be in the Pillar 2. But on the other hand, more in depth, you could look to whether or not the safe harbor rules are applicable, and that will help you also to be compliant. So there's a lot to do, but you have to do it rather sooner than later, because time, the clock is ticking at the moment.
Yeah, and you also mentioned data gathering. Of course, that seems to be quite one of the biggest challenges maybe of this Pillar 2 requirement.
Yeah, data gathering is a big thing, because you have to realize, are your systems ready? Are they accessible? Also, timing is a problem. So suppose that you have some hiccups in between. Do you meet the deadlines? So there's a lot to do. Absolutely.
Yeah, and I understand you will get back to those details later on in our webinar. So, dear viewers, based on our experience, many organizations aren't fully prepared yet for Pillar 2. We see some organizations which have taken the first steps, and other organizations are still at the start of their preparation for Pillar 2. And that's quite understandable, of course, because there's still a lot of uncertainty with regards to the Pillar 2 implementation at EU level, but also with respect to the Dutch law proposal. But in order to help you as clients, prospects, to be prepared for Pillar 2 when it's implemented, we have designed a so-called 7-step approach. And you will see that 7-step approach on your screen now. Like it says, 7 steps. It consists of 7 easy steps which will help you through the process of getting compliant for Pillar 2. And in the following, we will help you explain these steps step by step. So Onno, may I please give the word to you to explain our viewers the first step?
No, I will do the first two steps together. Now,
Great.
the first is the overview scope. And it's basically to determine, do you reach the threshold of 750 million revenue? And you have to calculate it on the group level. So it doesn't matter if you are in Pillar 2 countries or not Pillar 2 countries. Every revenue is counting for the 750 million threshold. Besides that, a permanent establishment is also taken into account as a separate entity for your calculation. And what we do in step 1, we make an overview. So let's assume you are in scope of the 750 million. Then we make also an overview of which country is a Pillar 2 country and what kind of rules can be applicable. So it's a more high-level view of your company and do you fall in scope. The second one is let's say, the most easy way if you're qualifying for it, because then if you fall in the exemption, Pillar 2 is not applicable for you. There are companies like governmental companies, pension funds, non-profit organizations, but also some kinds of real estate investment vehicles. They are, let's say, basically exempt from Pillar 2. There must be make a distinction if those companies are the ultimate parent entity or if they are subsidiaries. But in both cases, it can be possible that they are exempt from Pillar 2.
Okay, great, thanks. So if I understand you correctly, basically step 1 and 2 could be done in a rather high-level analysis with simple data. But how about step 3, the safe harbors? Is that the same? Or is
No,
definitely
not. This is more and more complex, because if we are talking about the safe harbors, there are 3 safe harbors. The first is the minimus toets. The second one is the simplified ETR. And the last one is a routine test. If I elaborate a little bit more on those tests, the minimus test is per jurisdiction. So you take a look whether or not you take it to the CBCR, and we come back later in the story, but CBCR is very important at this moment for Pillar 2. So you take a look at the CBCR revenues, and if it's lower than 10 million, and an additional, if your CBCR profit is less than 1 million, you fall in one of the safe harbor and you're carved out for Pillar 2. The second one is a rather, let's say, simplified ETR calculation. So you see your total tax expense and you divide it by your total income. And it's a very simplified calculation if you compare it to the, let's say, Pillar 2 calculation. And if it's more than, at this moment, 15%, then you're also carved out. It's good to mention that this 2023 and 2024, it's 15%. 2025 is 16, and 26 is 17%. Okay. The last one is the routine test, and that's also a completely different test. Then you take a look at what they call it the substance income, and that is calculated based on your percentage of your tangibles asset and your waste tax. So if your waste cost, sorry, if that is more than your CBCR income, then you're also tax exempt for Pillar 2.
Okay, interesting. So hearing from what you're saying, it seems the CBCR report is really important for calculating the safe harbors, determining whether they apply.
Correct. Yeah. And the CBCR is also leading for all Pillar 2 this calculation. Please note that it's only from the period 2026 to 2028. So the CBCR is very important. It's also important for us if we're helping the clients not only take a look at the CBCR, because the CBCR was originally only for reporting purposes. Mm-hmm. So we must make correction for tax liabilities, but also make a list of all the tangible assets. We must know what the wage costs are. So it's more than CBCR. At this moment, the CBCR income is also leading up to 2028. And after that, we get a, let's say, globe income definition, which will be leading for the Pillar 2 the calculations.
Okay, yeah. So maybe also for our viewers, if you fall under one of the safe harbors, that means you do not have to make that detailed Pillar 2 calculation we were just talking about. But question to you, Onno, does it relieve you from a filing obligation in that country?
I wish it was true, but no. There is a benefit. If you're carved out for Pillar 2, it does not mean that you don't have any obligations anymore, but they are simplified obligations in comparison to companies that are under the scope of Pillar 2. So it helps you a little bit, but you still have the obligation to file and be compliant with your administrations.
Okay, yeah. Well, Jacob, it seems like, and the aforementioned steps which we just went through with Ono, the collection and the data gathered is really important. And that's not even to mention that we still have to get into the calculation of the top-up tax and the numbers required for that. Now, we talked about various information. We heard Ono talk about employees, fixed assets, CBCR reporting. But what are your comments on financial data? What financial data is required?
Yeah, it's good that we distinguish the financial data and the non-financial data. And when you look to non-financial data, think about, for example, amounts of employees. That's what you need to for the calculation. But yeah, there are also other things you have to be aware. So that's more about, for example, what kind of companies are in the structure. Are that hybrid companies or more or look-through companies or whatever? So, and also, where is the company situated in that structure? That's also something what you have to determine. So there's a lot of information, non-financial information you need, well, to be determine whether or not you fall under the scope. Further, of course, the financial information, consolidated returns, of course, and but also annual reports where you need deferred tax positions. So there's a lot of information you get, and yeah, what you see also to get into the calculation, you have to also make a lot of adjustments. So it is complex. It's really very complex. And besides that, when you look to these companies above 750 million, because that's the threshold, normally these companies are a result of mergers. So mergers means that you have a lot of different companies, normally with different systems. So with different ERP systems. And that could be, for example, Azure, SAP, or Oracle, or another system. But in the end, you need from all these systems to get the information, and that's going to be very hard. That's what we think. So in an ideal world, but yeah, it's not an ideal world, but in an ideal world, you think, okay, let's create a data pool. And that would mean that all the systems would connect to a data pool, and you would put in all your data in that pool, and then it would be easy to take it out. And that's not only for Pillar 2, because you have to remember there's also coming up ESG. And ESG is also a reporting monster, so to speak. Yeah. And if you have all that data in the data pool, maybe this is the moment to think about that. On the other hand, for a lot of companies, they will not do it, maybe too expensive, or there will be other reasons why not to do it. And then a simple tooling could help you to get your data in a very ordered and efficient way. So that's what we think would be best then to do. So data gathering is really, really very important here.
So I guess that data gathering out of our 7-step approach will be the biggest challenge our clients and prospects will be facing in order to prepare for Pillar 2.
Yeah, that's what we think. And think also about readiness and so on for your company and so.
Yeah. Okay, great. So apparently more detailed information is required in order to make that calculation of the top-up tax. Hearing from what Jacob just said, would you mind elaborating on the correlation between the financial data and the calculation of the top-up tax?
Yeah, well, they are both very important. The ETR and the top-up tax, they're all relating to each other. And if we take a look, let's see how the top-up tax is calculated. Sure. If we take the minimum percentage of 15% and we deduct it with per country the ETR in that country. So let's say 12%. So you have a rate of 3% which is relevant for your top-up tax. Then you are calculating your qualifying income. And your qualifying income there is a correction made for a percentage of your expenses for wage expenses, but also for your tangible assets. So you can deduct them from your income, and you multiply it with the 3% we just calculated, and that will be your top-up tax in your country. So they're all very related to each other.
Okay, well, sounds rather complicated. Maybe good that we share an example on this calculation.
Yeah, well, this is the calculation, and before it's good to mention for this calculation is that Pillar 2 definitions and definitions how we are used to for the Dutch corporate income tax, they are completely different. There are similarities, but it's a own calculation of your Pillar 2 income. And for Dutch corporate income tax purposes, we have, for instance, participation exemption, we have the innovation box, we have the tonnage regime, we have the tax loss carry forward. There are all kinds of things which are not included in Pillar 2.
Yeah.
And that means, for instance, a simple example, because you can make it as complex as you want, but a simple example is you have a Dutch entity who receives dividend out of a participation which is qualifying for the participation exemption. That means that for your Dutch corporate income tax, you can deduct the dividend received, and you are calculating based on that taxable income your ETR or your taxable amount. But for Pillar 2, you don't deduct it, so your income for your Pillar 2 ETR calculation is higher than your Dutch corporate income tax. And that means that, let's assume I have a 20% effective tax rate based on my Dutch corporate income tax. I must make a calculation if I receive dividends or a capital gains out of subsidiaries, if I still above the 15%. So the Dutch participation exemption will have negative effects on your ETR calculation.
Okay, interesting. Yeah.
And that is also what we see here in the example.
Yeah. So this is really an example of the ETR calculation. Jacob, I think you will tell us more about an example of a real life case on an IIR.
Yeah, we have here a, well, more or less real life case with a company A in UPE. We have in country B and two companies in country D. And when you see the country D, they have a globe income of CE1 of 2000 and CE2 of 1000. So for the ETR calculation, it's necessary to add those, because in one country you add those together. So the net globe income in that case is 2000 plus 1000 is 3000. Well, as we said, and you have already mentioned that on now, you have also the covered tax, and the covered tax is here given, and that's pretty easy for us. But normally you have to calculate that too, so that makes it also very complex. But here it's 180 and 120, so we add that too, and that's 300 total, and then you can calculate the effective tax rate. And the ETR here is 10%, so the 300 divided by 3000, and that's too low. So that means that we have to add for the top-up tax the 5%, and then you're again on 15%. So that's the calculation, and now it looks a little bit simple, but in fact it's not, because you have to do those covered tax and those globe income calculations, but they are given here, so it makes it easy for the example. Then you have to calculate the excess profit, and the excess profit is some sort of a exception which you could take into account where you get a little bit of a deduction. So let's look into that. First of all, you have to look to the payroll cost. In this case, that's 200 and 100, and the total costs are then 300. And you have to look at the return on your intangible assets, and that's also given here, that 300 and 200. It's a total 500. So then you get the substance-based income exclusion, and what you see, normally this percentage for the transition period are a little bit higher. That's 8% for the intangible and 10% for the payroll costs. But in this case, for the example, we take 5%. So we take 5% of 800, and that's 40. So the 40 we can deduct here from the globe income. So the 3000 deduct 40, and what's left over is 2960. And if we look onto the top-up tax, that's a simple calculation. And in the end, because that's the 2960, with 5%, that's 148, and that's the additional top-up tax. So when you look to this simple calculation, you see it's already complicated, but then we made it rather simple. So when you do it in a real life case, it's really will be incredible complex.
Yeah, I totally understand. Yeah, really complex calculation.
Yeah.
And this now gives us the top-up tax per jurisdiction. But one question to you: at what level will that tax be levied?
Well, it depends. It depends on two things. Well, the first of all, we talked about the qualifying domestic taxation. That is per country, so it's independent whether or not where the taxation take place. So, for instance, I took the example of the Netherlands.
Yeah.
Then the taxation will be in the Netherlands. We take a look at the group's entities. Is the effective tax rate less than 15%? There will be a additional taxation in the Netherlands for 15%. And the other two rules, we discussed about the income inclusion rule and on the tax payment rule. The income inclusion rule is enforced if the ultimate parent shareholder is a Pillar 2 country. So that means that then at that moment, if that's the case, then the taxation will take place at the level of the ultimate parent company. It is also possible that the ultimate parent company is not located in a Pillar 2 jurisdiction. Then, as mentioned, then the taxation will be at lower level in the subsidiaries, and it can be in multiple subsidiaries based on the, let's say, what we talked about, the tangible assets and the waste costs.
Yeah.
So it all depends where is the Pillar 2 jurisdiction located, or where is the entity located? Is it Pillar 2 jurisdiction or not?
Yeah, so indeed, so the multinational group should look at each jurisdiction in which they operate to determine if Pillar 2 has been implemented there in order to answer the sixth question or step plan, who has
correct,
the right
and also to see whether or not if there is a taxation at what level it occurs.
Yeah, excellent. So, dear viewers, this was step 6 of our approach with respect to the question, who taxes? Now, let's get on to our final step, which is the filing of the returns. Would you maybe want to elaborate on that, Jacob?
Yeah, well, the filings of the returns, what we are seeing is we have those deadlines, and these are very important. So again, it's 2026, it's the end of June and the end of August. And we have to do the information tax return and, of course, the Pillar 2 tax return. So these are deadlines which we really have to take into account. The other thing is, of course, who's going to do, and you elaborated already a little bit about that, who's going to do the tax return? Who's going to submit everything? So that's also something to consider. And furthermore, something else what we have to keep in mind is, of course, penalties. Because penalties is a big thing. So, and now the penalties for the Netherlands are set to 900,000 euros. That's an incredible high. So yeah, it's something that you need to consider. So you cannot walk away from Pillar 2 because of the compliance rules that there are, and of course the penalties which are into account.
Ridiculous amounts of penalties. Same as we saw, of course, with CBCR and DAX 6, also
absolutely
crazy amounts involved. Thank you for that detailed explanation. And again, we would like to emphasize that Pillar 2 is just around the corner. And as you can see from the calculation Jacob just did, it's not a walk in the park. So we really recommend companies to take action on this sooner rather than later. And of course, Grant Thornton is able to assist in this respect. Jacob, would you please be able to share some key takeaways from for our viewers from today?
Yeah, I think, well, what we might try to make clear, because we did, let's say, a simple and more high-level Pillar 2 exercise, but in principle, it's a very complex law, which you have to get known to, where you need a little bit know where are the what you have to do. So it's good to have the risks in scope for your company. Which companies are into scope? What challenges do you get? Data gathering is a very big thing here. If you do this too late, you don't have enough time to complete that. On the other hand, what's also important is to remember in my situation that safe harbor rules are very important. Now it could help you to get a solution that you don't have to go maybe into those very complex situation of calculations, but you can just stick to the safe harbor rules. So these are a few things what you have to take into account to get ready for Pillar 2.
Yeah, perfect. Thank you. Thank you. And to our viewers, thank you, of course, already for watching. As we keep mentioning, it's important to take action now. We only had 45 minutes, of course, in this webinar, so we haven't been able to touch base on everything. But please note that we have a detailed and dedicated website available on Pillar 2, in which you can find more information. We will also be providing masterclasses to go in more depth on the various steps and how to prepare. And we will also publish weekly updates with videos on the 7-step approach. Furthermore, Grant Thornton can, of course, assist with a quick scan to determine if you fall under the scope or under the safe harbors of Pillar 2, but we are also able to provide you with a more detailed analysis on the risks of Pillar 2, how to get prepared. And we have a specific developed data room available to do this. Now it's time to go to the Q&A to see if there are any questions from our viewers. Let's see if there are any. So we can help you with those. I see here a question on which countries have an effective tax rate of, or a tax rate of less than 15%. Which of you wants to answer that one?
Yeah, I can say something about that. There are a few countries in Europe, like Ireland, for example, 12.5. Well, there is Liechtenstein also on 12.5 and Hungary on 10. And of course, there are some countries outside Europe which has low tax rates. So yeah, there are a few, and still also in Europe too.
Okay, great. Another question I see here is, we have a parent company which is in the US. Does it also apply for Pillar 2?
Well, I can answer that one. No, it does not, because Pillar 2 is stalled in the US. However, there is I don't say it's comparable, but there is a guilty rules in the US which also protects a minimum taxation in the US. So it's not Pillar 2, but it's the guilty discussion they have over there. So no Pillar 2, but guilty.
Yeah, and to get on guilty, that's nice, because that's one of the other questions I see from the public. So what is the difference between guilty and the Pillar 2 minimum tax? So are they essentially the same thing?
No, they are not the same thing. There are a lot of differences. There's a completely different approach of them. However, what good is to remember is that the guilty is qualifying for sufficient taxation for the Pillar 2 discussion. So it can help you to avoid the Pillar 2 discussion if you have the guilty taxation in the US.
Perfect. Let's see if there are some final questions. Yes, last one. So our parent company is located in a non-EU country with no Pillar 2 compliance yet. Will the Dutch BV have a reporting obligation for its subsidiary located in low tax jurisdictions? Which one of you wants to answer that one?
Yeah, that could be the case. In this case, it will not be IIR because the Netherlands is not the ultimate parent company. It will also not be the QDMTT because in the Netherlands there will be enough tax. So it will be the UTPR if the other country is not have enough tax, and what you see the mother company is not doing IIR. So then it's the UTPR, and the Netherlands has to do that.
Okay.
Yeah.
Interesting. Well, I see those were our questions for today. Dear viewers, if you have any other questions, feel free to raise them in the chat and we will get back to your question later on. Thank you both for your attention. Thank you, Jacob. Thank you, Anna.
Thank you.
It was great having you here and explaining more about Pillar 2. To our viewers, thank you for watching, and please check out our website for further information on Pillar 2. Thank you.